Hello, my friends. Ivan Oberon here, your favorite mortgage consultant and real estate investor with Prosperity Home Mortgage, here for another value add presentation. And today we're going to be talking about jumbo loans. And here in California, specifically in Southern California, where I do most of my business, but pretty much lots of different places in California, it doesn't take much these days to get into what we call a jumbo loan territory. And not every jumbo loan is created the same. And there's some unique things that we're going to talk about tonight that we can bring to the table to help you and or your clients have more options than just, hey, do we qualify under these jumbo guidelines, these boxes? So we're going to talk tonight about some of my jumbo loan niche products that maybe are for people that want a little bit of flexibility in their particular loan when they're purchasing in that range. Now, in LA County, where I do a lot of business, the high balance conforming loan is a maximum of $822,375. So if we go above that in a loan amount, not necessarily having anything to do with the purchase price, because I've seen people purchase $3 million homes and put a huge down payment so that they're still under that conforming loan limit or under the jumbo loan limit in the high balance conforming. So it's all a matter of once that loan limit gets above that 822, now it becomes a jumbo loan. You're in a jumbo program, and there's certain guidelines and parameters that are a little bit tougher to qualify for than a conforming loan. But what if you need some flexibility? Well, that's what we're going to talk about tonight, just so you understand and you know what is available to you so that you can have educated conversations with your clients and or make a decision for yourself. So let's get started. Now, there's a few different things that we have a difference here in California. Most people know that if you want a jumbo loan, more than likely you're putting 20% down or more. Well, we have programs that can go as high as 90% LTV or CLTV, combined loan to value, which will give you in effect a 10% down jumbo loan. I also have a 15% down jumbo without a concurring second with no mortgage insurance. So that's pretty exciting. Now we can also do investment properties with no income, verification up to 80% LTV, so 20% down there, a departing residence loan, which we'll talk about, cross collateralization loans up to $10 million there. Here's a really cool differentiator. Now, if you know anything about mortgage, you know that part of the main qualifiers is your debt to income. And on the conforming loan programs, the debt to income max is 50%. Under jumbo, traditionally it's always 43% debt to income, so it's a little bit stricter. Well, what if we could also offer you 50% debt to income on a jumbo loan? What does that do to your buying power and your ability to qualify for a loan? We're going to talk about that. We have asset distribution in order to help you qualify. An asset qualifying program. So let's dive into what all those things are. And here's another one that we have. We call it investment property or no income. I call it a DSCR loan or a debt service coverage ratio loan. And just to keep things simple, where a traditional program, jumbo or otherwise, looks at you as the client, as the borrower, your debt to income to qualify. This looks at the debt service coverage ratio or DSCR, which is essentially the income of the property, right? It's the debt to income of the property, not looking at the borrower themselves. So if you don't want to have to qualify, or you file your taxes a certain way, or if you just don't flat out have the income, but you have an investment property that you want to get into, as long as the property itself qualifies, we can do the loan. Super exciting program. And we can do purchases, rate and term refinances, and again, that's going to be a max LTV of 80%, so 20% down on that. We can do cash out refinances, and it's a 1 to 4 unit properties in order to qualify. There's a couple of different options. You can do a 7-year ARM, or you can do a full 30-year fixed, either interest only or fully amortized. So that's really pretty cool. And what does it take? Well, the debt service coverage ratio, that simply just means that the income of the property has to cover the corresponding liabilities of that particular property. What are those things? You got your principal, your interest, your taxes, and insurance. And if there happens to be a HOA, of course, you have your HOA, Mello-Roos, all those different things that are associated with the property, if applicable, that's what it is. And it has a 1.0 DSCR requirement or 100% debt service coverage ratio. As long as you meet that, well, guess what? It qualifies. And here's what we look at. If there's a lease in place, then we'll take 100% of that rental income verified by the lease to qualify. So let's just say that the property rents for $4,000 a month, and the principal, interest, taxes, and insurance are $3,500 a month, or just to say $4,000 a month. Well, as long as it's even, it's at least 100%, it qualifies. Now, of course, as an investor, I'm going to recommend that if property rents for $4,000 and the expenses are $4,000, that's probably not a good investment just to be able to break even. But theoretically, we would still do the loan because it qualifies. All right, makes sense. Super cool program. And so here's an example that Pacey already went through, but that's the way it breaks down. You just got to qualify based off the income. The expenses can't exceed the income of the property. Expenses specific to the property itself, not any other property that you have, not any other debts that you have, just the property. So it's pretty cool. Then we have our cross collateral program in the jumbo space as well. And of course, this also applies if it's not a jumbo loan, we can still apply this program, but we do purchases, rate and term refinances as well for these types of programs. And how does the cross collateralization program or cross collateral program work? Well, let's just say that you're looking to purchase a property. We're going to go into the example right now. Let's just say you're looking to purchase a property, but you already have a property that's going to be your departing residence. Okay, you can take the value of that departing residence and you can use that value and cross collateralize it towards the purchase of the new property. The cool thing about this is, like in this particular scenario, you could potentially have a zero down scenario even in a jumbo program. So let's just say you're looking to purchase a new property for $2.5 million, and the value of the current property is $4 million. Well, that's a total value of $6.5 million, which means that with a 75% LTV, we could do a max loan amount of $4.225 million. So it's going to be more than enough to cover the purchase, the closing costs, etc. And so you wouldn't need to have any money out of pocket. Now, what happens with the other loan or the other property? Well, a couple caveats. One, there has to be a first position lien on both properties. So if there's a mortgage on the departing residence, we would essentially replace that mortgage, pay it off, and have the new lien on the new property. And when you go to sell the property, then of course you would just pay down and pay back the portion of that equity that was used to put towards the new purchase. Okay, so that's kind of a cool program that can be very useful for some people. Now let's talk about that debt to income ratio. That can be huge because it can increase your buying power significantly. So what does that do for you if you're an agent watching this? Well, it could potentially increase the pool of potential buyers that you can work with, because now you can target all the people that maybe don't make quite as much money in order to qualify for the 7-figure value properties that they're looking for at that 43% DTI. Now with the 50% DTI, you can buy a lot more house if you have the income, or you can come down to buy or to find more buyers in that particular space that can come up. So what does that do? In this particular case, if you're a typical lender with a 43% DTI, you're gonna have a loan amount in this particular scenario that requires $18,750 per month in income to qualify for a $1.32 million loan. In our particular case, look at this, the difference in this buying power. It gives you an additional $350,000 in buying power that you can scale up and maybe buy the home that you really want, or again, have somebody who wouldn't otherwise qualify to purchase the home that they need. And in this particular scenario, for other lenders to qualify for the same loan, that person's going to have to make $21,800 a month. With us in this particular program, they only had to make $18,750 per month. So that's a $3,050 a month difference in income for that borrower. That's huge, right? That's like adding a co-borrower that makes about $40,000 a year, a little bit under $40,000 a year. I know that off the top of my head because I'm dealing with one of those scenarios right now. So, but it's big. It's like adding adding another borrower to the table, or not having to add that other borrower. So it's huge. We're one of the only lenders that's offering this 50% DTI on jumbo if somebody needs it to qualify. It's an awesome program. Now, what if we're a little bit short? What if we're somebody who's a little bit older, or of retirement age? The asset distribution program to qualify is awesome, and we can do this on any kind of loan program, but we use it quite a bit on jumbo loans, because sometimes we have somebody who's maybe not working as much, maybe he's retired, they have their Social Security, maybe they have a pension, and they have a couple other things, but it's maybe not quite enough. But let's just say that they have $1.5 million in retirement somewhere, in an IRA or somewhere that they can access penalty free. Now we can do, in this particular example, in this $1.5 million, we can actually give them an extra $28,370 a month in qualifying income. So that's pretty good income, even if you didn't have Social Security. Let's just say you have nothing else. That's a pretty darn good qualifying income for somebody that we can use with this asset distribution. So the only caveats are that you have to have penalty-free access to the money, and then literally I've done it so many times that like Schwab, for example, I know they can set it up in the same day. They send you a letter, they set up the distribution. You can get a distribution literally within a day from this thing, and that's all we need to see to verify that the distributions have been set in place. And here's how it works: we take the actual outstanding balance of that retirement account and divide it by 37. By 37, a little bit of a buffer, but it always requires, underwriting guidelines always requires that we can show a continuance of at least 3 years of income coming from these types of accounts. So that extra month gives us the buffer for when we're in escrow and whatever's going to happen there to qualify, and we can be conservative that way. So it's awesome way to help people qualify who in some cases wouldn't otherwise qualify. And I closed a loan using this particular strategy this last week, which was great because we were able to add $2,079 extra income per month. And man, let me tell you, that makes a big difference in your buying power and qualifying DTI when you can add a little bit extra income. Oh yeah, asset qualifying. I also have been working on one of these, and this is a great program because sometimes there's people that have no income, but they have assets. They have very limited income, or they just file their taxes in such a way that shows almost no income or net loss. I have a client that really he brings in about $475,000 a year into his company through his statements, but the way that he writes everything off and this and that, like at the end of the day, the net loss is like $40,000. So it doesn't allow him to qualify for a whole lot. But guess what? They have a lot of assets. So in this particular case, we can go up to 90% LTV, up to $1.5 million, and the LTV drops slight percentages as the loans increase, right? Because the loan becomes a little bit riskier loan, the bigger the loan is. So the LTV drops down a little bit. We could do second home, non-owner. We can do refinances, whatever it is, still the 1 to 4 units. And there's also an ARM option and a 30-year fully amortized option. And here's the basics that we need for qualifying. We need 6 months of bank statements for the funds that are going to be used for qualifying on those assets, just to show that there's an average balance being held for those 6 months. And we can use 100%, of course, of liquid assets, things that are immediately available. 90% of stocks, mutual funds, unless you liquidate them and you put them in a actual account, then it's 100%. 70% of retirement accounts just for qualifying, and 100% of cash value life insurance, which is huge. The other thing for qualifying is we have to show at least 60 months worth of debt service for all their other liabilities and their debts, right? So that's all part of the stack of money that they would need to have in addition to 100% of the purchase price. So if the purchase price is $1 million, then we need to show at least $1 million plus that 60 months worth of reserves for all their other liabilities in order to qualify. So it's pretty easy math. You just have to have the assets, and once we have a property, we can do it. But that's another way that you can get yourself or a client qualified who maybe otherwise doesn't have income, but they have good assets. So that's a little bit of a rundown on some of our jumbo niche products. We're very aggressive in the jumbo space. I know that our rates are very hard to beat in the jumbo space, and our rates in jumbo have been consistently even better than conforming loan rates for quite some time. So give me a call if you have a scenario that you want to discuss, whether it's going to fit a box and it's cookie cutter. I love those, of course, but the more challenging ones, maybe ones that need a little bit extra love and care, we have that too. So reach out to me. I hope you got value out of this video. Share it if you did, and of course, let's talk. And until next time, God bless. Talk to you soon.